All right, welcome back to another market update. Today is March 8th, 2022, and we're coming off another strong down day in the markets yesterday. In fact, yesterday was the S&P 500's largest down day since October of 2020. Let's start off looking at the drawdowns chart updated through Monday's close. You'll hear various pundits assign names to specific levels of drawdowns. Many call a 10% drawdown a correction. 20% drawdown may be called a bear market, and beyond that, perhaps a crash or even a crisis as you get to 40% and beyond. Whatever label you choose, here we are with S&P 500 off 12% for the year, NASDAQ at almost 20% drawdown for the year, and the small cap Russell 2000 at about 14% drawdown for the year. Now keep in mind, these are just for the calendar year, as the NASDAQ and Russell 2000 actually peaked last year, as shown by the return from the one-year high. And as we look under the hood of the indexes, we see the vast majority of stocks in each index has drawn down at least 10%. Well over half of the members of each index is down at least 20%, and almost half of the NASDAQ stocks are down by at least half from their one-year high. Just the S&P 500 alone has wiped away $4.76 trillion of value. And this year has been even more challenging because our major diversifiers, bonds, are also down for the year. The major bond benchmark, the Barclays Aggregate Bond Index, is down 4% for the year, and the 20-year Treasury ETF, TLT, is down almost 7%. Stocks down, bonds down.
It's almost as if the only place to hide has been in commodities. Now, commodities are a bit of a different animal. In general, commodities describe a broad basket of natural resources, broken down into categories like energy, agriculture, base metals, and precious metals. And in 2022, they're stealing the show, with a broad-based commodities ETF up 35% this year alone. But not so fast. We're long-term investors, aren't we? The 10-year return for this fund, including the strong recent performance, is 0.01% after 10 years. That means for 8 years, you would have been languishing with an asset that doesn't pay income, that costs money to hold, that was down 30 to 40% for the better part of a decade, and relied on an unprecedented global pandemic and Eastern European war just to break even. I'm exhausted just thinking about it. Folks, you may be able to trade commodities or even ride a trend for a while, but we do not view commodities as an asset class to hold as a strategic long-term investment. We even heard many fund companies and investment firms call for a commodities supercycle in 2017 and 2018. Perhaps that's happening now. The future will tell. But we don't believe strategically holding an asset class that is so inconsistent makes sense for our clients.
It reminds me of that story during original COVID in 2020 when I couldn't believe it, but Wimbledon was canceled. Then the story broke that Wimbledon had been paying $2 million a year for the past 17 years for a pandemic insurance policy. And that $34 million of insurance premiums paid out $141 million for the claim. That's a wonderful return on investment for them, but there are so few things that we as humans dealing with an unknown future can tolerate year after year after year with no payoff in sight to keep barreling your hard-earned assets into. We believe we can accomplish outcomes without relying on any asset that might take 15 to 20 years to pay off.
So perhaps the Russia-Ukraine conflict exacerbated some market weakness that was already waiting in the wings, so to speak. With all the uncertainties out there, the Fed both hiking rates and tightening its balance sheet, less fiscal support, weird supply chain disruptions, a new bout of inflation, high stock market prices in general, and the midterm election year. Depending on how you label it, so many stocks are already in correction, bear market, or even crash levels. That's already happened. It's in the past. And I think for the most part, we're doing okay. but it may help to understand a bit more about what's been driving the market decline this year. Now, market returns can only come from a couple places: actual company earnings, cash returns to shareholders, usually we call this a dividend, and the value investors are willing to pay for those earnings. The most common metric for that is the price to earnings, or PE multiple. When people say the market's expensive, the PE multiple is high. When they say the market's cheap, that's a low PE multiple.
We can see that in 2018, even though the market had positive earnings because investors were willing to pay less for those earnings, that resulted in a negative return for the market. In 2019, the multiple expanded again, along with earnings, producing a strong year for stock market gains. And then in 2020 and COVID, that was a unique year, with earnings down but multiples up. And here so far in 2022, again, we have a lower multiple, even with solid earnings, producing a lower stock market for the year.
So why might valuations be contracting? While the Russia-Ukraine conflict may have an impact, we believe the market was anticipating the other uncertainties we've been mentioning so many times before. As the market shifts its focus to those other items, it always does, and as some of those uncertainties resolve, we expect the market to settle back into some semblance of normalcy.
Please always keep in mind how things play out over the next 12 weeks isn't nearly as important as how it plays out over the next 5 or 10 years. And tolerating this volatility is the ticket to earning higher returns than bonds or cash in the long run. Be well and see you next time.